Okay, I'm about to show you exactly what I do every single week, step by step, to get positions that actually expire worthless. And that is the sole goal of the wheel strategy. So the first step is I use a stock screener. Here I've set a couple of criteria that I use to find stocks that will work for this strategy. The first one is the share price. So this is going to be depending on your account size in total. I like to go under $50. This gives me positions that are under $5,000 needed in collateral for the cash secured put. If you have a lower account size, you might want to go under 20. It really depends on your account size, once again. So that's the first criteria I do change on my screener. If we scroll down here, I also choose market cap. This is very important. I only like to include companies that are well established and have a proven track record of good earnings reports in the past. So I set this market cap value at least $1 billion dollars or higher. So I'll save that. And then we go back, and this is the next one I change is the implied volatility level. This is a very important aspect when trading options. The higher the implied volatility, the higher the options premiums are going to be for the contract itself. The trick is you don't want this to be too high because you don't want the stock to move too erratically and basically have your risk for capital loss be too high. So I like to make this between 40 and 80%. This gives me a good level of premium while also being a little risk tolerant as well. So 40% on the low end, 80% on the high end. Next, I just make sure that options are available. You clearly need options to do this strategy, so make sure that's available. And options average volume. This is a very important aspect as well for the liquidity. So you want to be able to get in and out of your options quickly, and you want there to be enough liquidity around the options volume itself. So I set this to at least 5,000 options contracts traded per day. That is the last thing I change in my screener. And this has now populated 90 stocks that meet all of the criteria that we just changed. And here you'll see a bunch of different stocks that would work well for this strategy. Let's go over a quick example on Chewy. This is the 28th stock in the current list we have here. If we pull up Chewy on this other tab here, we can take a look at some of the criteria I look at for selling the cash secured put and actually picking the strike price. So that first part was just to pick the stock itself, right? The stock itself is a very, very important aspect. The next important aspect is picking the strike price of your cash secured put. So this is exactly what I look at as well. I pull up the Bollinger Band, which basically creates a two standard deviation range around a 20-day moving average, which I've set up here. You can take a look at these settings here. 20 SMA, two standard deviations above and below that value. If I zoom in here, we can see that the current price of Chewy is $36.22, is this black line here. It's very close to the bottom of the Bollinger Band, which is at 35.66 right now. So this is exactly where we want to start selling a put option because there's a highly unlikely chance that the stock price will go all the way down to the bottom of the Bollinger Band. Statistically, about 95% of the data live between these two blue lines. And that's exactly what we want to exploit by selling a cash secured put at these low levels. Statistically, about 5% of the time, we will be assigned on this position. And that is still not a bad thing at all. The next thing I like to look at is the 30-day moving average. This is this red line here. And basically what this is telling us is the stock price is drastically lower than the 30-day moving average as well. Stocks tend to move back to the 30-day moving average. This gives us a good indicator that the stock is likely on the uptrend as it has reached a relatively low level compared to the Bollinger Band and the 30-day moving average. So that is exactly what we're going to do We're going to go take a look at the premium on the options contract at the $35.50 strike price, which is the very bottom of the Bollinger Band. I'm going to pull up the Chewy options chain here on Robinhood, and we can take a look at some of those premiums for expiration next week. I like to trade weekly expiring options, so I'm able to reinvest my profit at a quicker rate. We check at the $35.50 strike price. We collect $47 for being in the trade only 8 days. This is a really, really good return and something you can consistently achieve if you are using the Bollinger Band as a assist, right? And that's very important in getting into the stock at a low price. Likely you will not be assigned on this position and you'll be able to collect $47 for putting up $3,550 for 8 days.